The next talk is presented by David Press, data scientist at Doordash. Like all online businesses, Doordash battles fraudsters who attempt to place orders with stolen credit cards. In his presentation, David will show us how they leverage machine learning to identify and block fraudsters while minimizing impact on the normal customers. Over to you, David.
Good morning. My name is Dave Press. I'm a data scientist at Doordash, and today I'll talk about balancing the fraud equation, or how we optimize fraud model thresholds and actions. First, a quick introduction of myself. I've been working on the fraud team at Doordash for a little bit over 1 year. And prior to Doordash, I worked on Airbnb's anti-fraud data science team for a bit over 4 years. And a fun fact about myself, between those two roles, I took 18 months off as a sabbatical to ski and mountain bike around the world. So I think most folks now are probably familiar with Doordash. We're essentially a three-sided marketplace that connects hungry consumers or shoppers with restaurants and stores, and we leverage our fleet of more than 1 million Dashers to help deliver the goods. Unfortunately, like all online businesses, Doordash faces fraudsters who'd like to make purchases with stolen credit cards. So a quick overview of how that works. Typically what happens is a fraudster will buy a batch of stolen credit cards on the dark web, and then they'll use those credit cards to place orders on Doordash. So why would the fraudster want to do that? Well, sometimes they're just a hungry fraudster who wants free food, but more often than not, the fraudster is actually looking to extract cash out of those stolen credit cards. And a few different ways that they can do that. One is by setting up a reselling business where the fraudster basically advertises through illicit channels that you can purchase DoorDash here at more than 50% off, 80% off DoorDash. And they'll take orders from hungry folks and they'll place orders using stolen credit cards on DoorDash on those folks' behalf and have the food delivered to them. And in doing so, they've been collecting cash from those folks at a steep discount. Another way that fraudsters can extract cash from credit cards is by a method called collusion, which is where the fraudster creates a fake merchant or a fake restaurant on DoorDash and then places orders with themselves using those stolen credit cards and extracts the cash through the merchant bank account into their own bank account. At the end of the day, the cardholder is going to be alerted after the fact by their bank that there were unauthorized charges. And when the cardholder looks at their statement, they verify that there were in fact unauthorized charges made on their credit card. They issue what's called a chargeback to their credit card. Now that chargeback makes its way through the payment system and DoorDash reimburses the cardholder for that chargeback, and we don't pass the liability for that chargeback through to the merchant, so we end up eating the liability for those chargebacks. So we put a lot of effort into making sure that people can't use stolen credit cards to make purchases on DoorDash. So with that introduction, here is the outline. I'll start by giving an overview fraud fighting system at Doordash that I like to call Detect and Deter. Then I'll give an overview of some of the frictions that we use. And a friction is basically product flow that we build out with the goal of stopping fraudsters, but hopefully allowing good users to get through. Then I'll talk about how we optimize the deterrence framework, which is kind of the meat of this talk. I'll talk about how we measure the parameters of our frictions using A/B tests. And then finally, I'll walk through a numerical example of blocking a transaction versus applying the friction. So here's an overview of the overall detect and deter framework that we use to fight fraud at Doordash. The basic idea is we have new orders come into the system, millions of new orders every day, and we have to evaluate each order's risk as to whether it's at an elevated risk of being placed with a stolen credit card. The way that we do this risk evaluation is manyfold. First, we have dozens of rules that execute in parallel. We have an in-house machine learning model that's trained on past examples of chargebacks, and this ML model is kind of the workhorse of our fraud detection system for chargebacks. And in addition to that, we also have multiple signals coming in from vendors who run their own ML models. Now, when we do detect that a given order is at elevated risk of being made with a stolen credit card, we take some kind of action to mitigate the risk of that chargeback happening. If we're really confident that a given order is being placed by a fraudster, then we might go so far as to ban or block that user. But more often than not, most of the time we're sort of in a gray zone where something looks like it has elevated risk, but we're not certain about it. And in that case, we'll apply one of these payment frictions to verify rightful ownership of the credit card. So here is a concrete example of what a few of those payment frictions look like. Again, these are product flows that we've built out to try to verify card ownership with minimal disruption to good users. So the first friction is one that we call card scan. And in this case, as part of the checkout flow, we request that the user pull their physical credit card out of their pocket and scan an image of it with the app. And what we're going to do in that case is both we'll OCR the characters off of the card to make sure that the numbers on this card do indeed match the credit card number that the user has already entered into our checkout flow. And also we're going to do some image detection to make sure that this looks like it really is a physical credit card and not just like a printout of a card or a shot of a computer screen or a Photoshop or something like that. The idea here is that when a fraudster buys this batch of stolen credit cards online, they're typically not going to get the physical cards. They're only going to get the numbers. So this should be pretty difficult for a fraudster to fake, but hopefully quite easy for any good user to complete. Another friction that we've built out is called second card. And so here's what second card looks like. This is the bottom of our normal checkout screen, and we've added some extra fields here that says, to complete your order, please verify your card by adding a second payment card that shares the same billing address. The idea here is that for most good users, this should be pretty easy to complete because most folks do have a few different credit cards that share the same billing address. But it should be difficult for a fraudster to complete because, again, when they buy this batch of stolen credit cards on the dark web, it's unlikely that two of these cards will have the exact same billing address. That's a look at some of the payment frictions that we can use to deter fraud when we have detected elevated risk. Now the question is, how do we optimize this whole system together? And once again, our fraud detect and deter system looks something like this. New orders come in. In this case, we'll just focus on our machine learning model as the main detection mechanism. And when the model determines that a given order is risky, we're going to apply one of these frictions to it. So I think most folks are probably familiar with the ROC curve, or the receiver operating characteristic curve. It plots out the true positive rate on the vertical axis and the false positive rate on the horizontal axis. And this is how we can characterize the actual performance of the machine learning model. Now, within the context of fraud, the true positive rate corresponds to the percentage of fraudsters that we catch. And typically, we might try to operate our model with a true positive rate somewhere around 70 to 90%. And the false positive rate corresponds to the percentage of good users that the model incorrectly scores above threshold. And we unfortunately apply a friction to these good users as well. And typically, we might operate our model with a false positive rate somewhere in the neighborhood of 1 to 10%. So now the question that we'd like to address is, what is the optimal threshold that we should set for a given friction or set of frictions that the model can trigger? If we move our threshold, let's say, up and to the right on this curve, which means higher true positive rate, higher false positive rate, we're going to typically experience less fraud on our platform. But because our false positive rate is higher as well, we're applying friction to more good users, so we'll get less growth. And this typically will lead to a better bottom line for the business. And more often than not, our finance team would probably want us to move in this direction. In contrast, if we move down the curve to lower true positive rate and lower false positive rate, we'll typically have more fraud happening on the platform, but we'll have more good user growth as well. And this leads to better top line growth. And typically our growth team would like us to move in this direction. Another question for us is, what is the optimal value to set our threshold to? And how can we determine that? So the way that we approach this problem is to convert all of the outcomes to common units. We're going to use units of dollars to make things simple. So we'd like to convert all of our true positives and false positives into a single unit of loss and then try to minimize that loss. So let me walk you through the loss function that we use. And this is the real crux of the presentation. So I'm going to spend a few minutes digging through each term of this loss function. The total loss L is represented by the red line on this plot. And that's, of course, what we'd like to ultimately minimize. The first term in our loss function is the cost of false positives. And that's what's represented by this blue line here. In the context of fraud, again, a false positive is when the model incorrectly scores a good user above the model threshold, and we unfortunately apply one of our frictions to this good user. So the cost of false positives is given by the number of false positives, FP, that comes from our ROC curve, multiplied by 1 minus G. Now, G is a parameter that we're going to measure of our friction called the good user pass rate. And what this means is when we apply a friction to a good user, what is the probability that that user will successfully complete the friction and go on to become a Doordash customer? 1 minus G is the probability that they fail the friction and they churn from DoorDash. And then V is the value of that good user. So how much loss does DoorDash incur every time a good user churns from our platform? The three of those multiplied together gives us the cost of false positives. Next, I'll walk through the two terms here that have to do with fraudster losses, and they're represented by the yellow curve on this plot. The first fraudster cost is the cost of false negatives. And again, in the context of fraud, a false negative is when the model incorrectly scores a fraudster below the threshold of the model, and we let that fraudster through without any friction. So if we're not applying a friction to that fraudster, then they have basically a 100% chance of committing their fraud. And then we're going to lose an amount C, which is the cost of the fraudster. So the cost of false negatives is the number of false negatives multiplied by the cost of each fraudulent event. And then the final term in the loss function is the cost of true positives. A true positive is when the model correctly scores a fraudster above the model threshold and we apply a friction to that fraudster. Unfortunately, fraudsters are pretty wily and they're constantly looking for ways to evolve and get around our frictions. So there's some probability that we parameterize as F that the fraudster is able to successfully complete our friction and still go on to complete their fraud on our site. So the cost of true positives is given by the number of true positives multiplied by the fraudster pass rate F multiplied by the cost of each fraudulent event C. So our goal now is to figure out how do we measure the good user pass rate G and the fraudster pass rate F, and how can we estimate the good user value V and the cost of a fraudster C. And just to add a little bit more context, a perfect or ideal friction would be one that has a good user pass rate of 100% and a fraudster pass rate of 0%. Now, if we had a friction like this, we would just apply it to 100% of our checkouts, and we would have no fraud happening on the platform. Unfortunately, frictions like this are pretty hard to come by. So in reality, we're going to have to measure our good user and fraudster pass rates, and we're going to have to balance and optimize our loss function. Next, I'll talk about how we estimate the cost of fraud C and the good user value V. Again, these are these two terms in our loss function. The cost of fraud, in principle, is pretty straightforward. It's just how much does a successful chargeback cost DoorDash? And there are the direct losses associated with the chargeback. We're going to lose the value of the order, plus there are payment processor fees associated with that chargeback. But there are also some indirect costs. For example, if we start to get too many chargebacks, our payment processors will start to decline more charges because we're going to start to look a little riskier to them. And that has a cost to DoorDash that we'd like to estimate. There are also indirect support costs. For example, if one of these victims of credit card fraud, quite often they might reach out to DoorDash directly to try to get their money back. And in that case, we'll certainly return it. But then we'll have indirect costs of our support team associated with helping out these victims. All those together go into the cost of the fraudulent event C. Now for the good user value, which is if a good user churns after being exposed to one of our frictions, how much harm have we done to the business? And in general, we'd like to align on the same lifetime value methodology that's used across different areas of the business. So hopefully we're using similar numbers on the fraud team as the paid growth team is using when they're acquiring new users. That's how we estimate the cost of fraud and the value of a good user. Next, I'd like to spend some time talking about how we quantitatively measure the fraudster pass rate F and the good user pass rate G. We're going to measure both of these with A/B tests or experiments. And just to walk you through how we set up these experiments, once again, here's the fraud system that we looked at before. We've got new orders coming in. We've got our ML model detecting which of these orders are risky and sorting them into a high-risk group bucket and a low-risk bucket. Now, this low-risk bucket, in general, we're not going to apply any friction to these, and these are not going to be part of our experiment. The high-risk group, if we weren't running an experiment, we would apply a friction to all of the orders within this high-risk group. And that would hopefully mitigate the fraud as much as possible. But we wouldn't really have a good idea about how much fraud we're actually blocking because we wouldn't have a counterfactual. So in this case, we're going to set up an experiment where a very small percentage of the high-risk orders are going to actually skip the friction. And we're going to call this the control group. So the vast majority of the high-risk orders are going to go ahead and get the friction. We'll call this the treatment group. And so we're going to compare some metrics between the friction treatment group with the no friction control group. And to measure the fraudster pass rate F, It's actually a pretty simple metric. We can just choose something like the dollars of chargeback per order assigned into the group. And then we can define the fraudster pass rate F as the dollars of chargeback per order in the friction group divided by the dollars of chargeback per order in the control group that gets no friction. And so hopefully we'll see that we get a lot fewer chargeback dollars coming through in the friction group than the non-friction group. Now, just a few notes about this experiment. We're typically going to run this as a very imbalanced experiment, as I've drawn here, maybe something like 99% in the treatment group and 1% in the control group. There are a few reasons for that. One is that it's very expensive for Doordash to have a group that gets no friction because these are our highest risk orders that we suspect are fraudulent, and so we're going to lose a fair bit of money in order to learn these labels. And the second reason is that we really want to make this difficult for fraudsters to game the system. If this were a 50-50 experiment, then a fraudster could just try twice in principle, and they'd have a 50-50 shot, and after 2 or 3 attempts, they'd have a pretty good probability that one of their orders, or if we're doing this as a user-assigned experiment, one of their accounts would land in the control group. So we want to make it difficult for fraudsters to game the system. So we'd like the vast majority of fraudster attempts to land in the treatment group. So this is how we measure the fraudster pass rate F. Now I'll talk about 2 different ways that we can measure the good user pass rate G. The first method is just to reuse the exact same risky order experiment, but measure a different metric. So here we're using the same experiment again, but remember that even though these are our highest risk orders, the majority of the orders here are actually still being made by good users. There's maybe like 10 good orders for every 1 fraudulent order in this group. So if we just measure the number of good orders in the treatment group compared to the control group, that gives us an idea of the good user pass rate. Unfortunately, this method has some drawbacks. One is that these good order labels are pretty unreliable and they're lagging. In fact, the only way that we can know that these orders are good is by the absence of us ever getting a chargeback for these orders. And it can take 30 to 90 days for a chargeback to arrive on any given order. And in some cases, that might never arrive at all. So that makes the good user or the good order labels somewhat unreliable and lagging. So an alternative method to measure the good user pass rate is to use this low risk group and to run a second independent experiment. In this experiment, we're going to apply a friction to a tiny percentage of these low risk orders. And because we believe the vast majority of these low risk orders are being made by good users, any dropout that we observe in the low risk group is going to be our good user dropout. So again, we can just measure the number of good orders in the friction group divided by the number of good orders in the no friction group. And the ratio of those 2 things gives us our good user pass rate. Unfortunately, nothing is perfect, and this method has its own drawbacks compared to the risky experiment method. In particular, this experiment is, again, pretty costly to run because we're applying friction to our known good users. And also, there's a chance that these low-risky users fundamentally behave different than the good users who are in the high-risk group. For example, the model might pick up on signals like a new user is probably higher risk than a returning user and is more likely to end up in the high-risk group. And a returning user, though, might have higher intent and might end up having a better probability of passing the friction than a new user. So there might be some bias that the low-risk users, good users, behave differently than the high-risk good users. So those are 2 different methods to measure the good user pass rate. Now finally, I've talked about how we estimate or measure all the parameters in our loss function, and I'd like to quickly walk through an example of how we apply the loss function to optimize our model threshold. This is just a hypothetical example with some made-up parameters. So let's assume that 1% of our orders are being attempted by fraudsters. Let's say that the cost of each fraudulent event is 10 loss units, and the value of each good user is 1 loss unit. I've made up some ROC curve. I've given you the formula here in case you want to repeat the math at home. And now I'd like to compare 2 different actions that we could take. The first action is blocking orders. And blocking orders, we can kind of consider this as a friction that has a fraudster pass rate of 0 and a good user pass rate of 0. So for blocking orders, nobody's going to get through. What we see is that we end up minimizing the total loss at around 6 loss units by blocking 1% of orders. But what if we instead apply one of these payment frictions that I've introduced before. And let's say that we've measured by some experiments that the fraudster pass rate of the payment friction is 20% and the good user pass rate is 80%. By plugging these numbers into our loss function before, we see that we actually minimize the total loss at 4.5 loss units by frictioning about 6% of total orders. So we can actually do better using our friction than we can by blocking orders. So with that, I'll wrap things up. I've given an overview of our detect and deter anti-fraud system. I've introduced a few different frictions that we use to stop fraudsters and let good users through. And then I showed how we optimize our deterrence framework by minimizing a loss function. I walked through how we can measure the parameters of our frictions using A/B tests. And I showed a quick numerical example of blocking a transaction versus applying a friction. Then finally, just a quick plug. Doordash data scientists have a huge impact on the business. Each member of our team aims to add about $10 million of incremental business value annually. And we do this by working cross-functionally with ML engineers, product managers, analysts, and operators. So if you're interested in learning more about the work we do at Doordash, you can check out our blog and check out our career page for opportunities. So with that, I'll take any questions.
Hey, well, thanks so much. That was a wonderful presentation. We do have some questions from the audience. Let me start with, what kind of models are you using and why these models?
So this is a classification problem, so we're using various types of classifiers. We generally prefer to use tree-based classifiers. We're mostly using LGBM models. Tree-based classifiers, random forest work pretty good as well. And we like to use models like this. They're just pretty fast and easy to put different types of features in. We don't have to worry about feature scaling and normalization. They do a great job of handling nonlinearities. And LGBM, just in practice, tends to outperform like XGBoost and random forest by a little bit.
Great. And I think we've got time for one very quick question. Which method do you typically use in the real world to measure good user pass rate? The high-risk experiment or the low-risk experiment?
So we actually use both of them in different contexts. For every friction, all the time, we actually have an ongoing high-risk experiment, so we can keep tabs on the good user pass rate that way. And typically, we'll run a low-risk experiment each time we develop a new friction so that we can get some idea. And then we actually have measurements so we can kind of triangulate what we think the real good user pass rate is.
Great. Well, thanks so much for that. This has been a wonderful presentation. I've definitely learned a lot. And for everybody, keep in mind, go back to the lobby when for the next edition. We've got Danny coming up from Nielsen, and you'll also find a pop-up here when this ends to take you to the next session. We look forward to seeing you there. Thank you.